Right, I think we have everybody here. Let's see. All right. Everybody see the screen?
Yes.
Yes.
Perfect.
You just need to click the button to start it, though, I think.
Yeah, for the from the beginning. All right. Nice and big now. Yes.
Yes.
Correct.
All right. Thank you, everybody, for joining us. We're going to get started. If you have any questions during the webinar, if you just type them in or raise your hand. We have a few people doing the administration, so hopefully we'll catch those in order. We do try to leave time at the end of the presentation that will allow for Q&A. If it's something pressing, just let us know and go from there. And we'll get started. Again, thank you everyone for joining us. We're going to learn today maximizing your high deductible plan with an HSA. Come a minute. Let's see. Next slide. Oh, it's going to go line by line. Okay, for an overview, we have from our ESI department, we have Amber and Erica. And this is the first of one of our webinars we wanted to try to plan for this season, for enrollment season, and look for others coming our way. And then from special guest is Eric Johnson from Benefits Weekly. Kind of, Eric, if you want to kind of give a little bit of a quick background and your knowledge from many times that I have done my continued education through the years for benefit or for insurance and just go from there.
Sure, be happy to. Thank you for inviting me, and thank you everybody for taking a few minutes to hear what we have to say today. I've been in insurance for a little over 25 years and spent about 3 years working for a health savings account administrator. So I'm, I guess, about as close as you can come to an expert on HSAs. And so hopefully we'll be able to share some good info that will convince some of you that you've got a high deductible health plan or have access to a high deductible health plan, maybe select that option and open a health savings account. So looking forward to the class. Perfect.
And I'm sorry, I was getting used to the slides going there. Amber, if you want to kind of give a little bit of your background, and then Erica, and then we'll go from there. Sorry about that in the beginning there.
Sure thing. I've been with my name's Amber Kerr. I'm the Benefits Administrative Manager here at ESI. I have been with ESI for over 4 years now, but in the PEO world for about 12 years. Have a great background in benefits and have worked with many employees to ensure, they understand what a high deductible plan is and an HSA. So looking forward to educating you guys a little more today.
Great. And Erica?
Hello, I am Erica Buenteo. I am the Benefits Account Manager. I've been with ESI for about 1.5 years now. I've been in benefits for about 18 years. So excited about the series, and hopefully we all learn something.
Perfect. All right, thanks y'all. And as we said, the purpose of this session is to help employees understand their HSAs so they can make informed choices during the open enrollment. HSA is very powerful, as you'll learn as we go through this. There's multiple ways of benefiting from it. And again, hopefully that will come through in the presentation. All right, the agenda is set right here. We're going to have a high deductible health plan, HDHP, just go over what those are. The HSAs, how can you use your HSA, getting started, and what are those contributions? Again, a reminder of the contributions for 2025 and then the contribution limits for 2026. And then, like I said, we'll end up with a Q&A and then some contact information after this presentation. Without further ado, I will turn it over to Amber, Erica, and Eric for the presentation. And again, y'all, if I'll try to watch for any questions or anything that comes up and jump in with anything after that. So take it away.
All right. Well, I guess I'll go first and just kind of quickly explain what a high deductible health plan is. So one important thing to understand is that it's really two separate things. So there's a health insurance piece, and if you have a certain type of health plan, then you're allowed to set up a account where you put money in that can be used for qualified medical expenses. So the type of health plan is called a high deductible health plan. I know that's not a very user-friendly word. It sounds kind of scary. The reality is the deductible on a quote unquote high deductible health plan, it's not really that high compared to other non-high deductible health plans nowadays. The main difference is a high deductible health plan, or a more user-friendly term is an HSA qualified plan. It's one that has a deductible of a certain amount, but does not have upfront co-payments for doctor visits and prescriptions. So unlike the other type of health plan where you might be able to go to the doctor and pay just a flat $30 or $40, when you go on a high deductible health plan, you're going to pay whatever price the insurance company has negotiated with that provider. So it's still a discounted rate, but it's going to be a little bit higher than the co-payments that you may have been used to on other plans. Preventive care is still covered up front, 100% coverage on preventive care. But for anything else, doctor visits, prescriptions, et cetera, you do have to meet that minimum deductible first. And then if you have a plan that looks like that, and you don't have other coverage that would disqualify you, then you can set up a health savings account, which we will talk about in a moment. Amber, Erica, I don't know if you want to chime in. I know that a lot of employers out there offer a high deductible health plan as an option, and during open enrollment, that is something that you have the option of selecting, and then you could set up an HSA.
Yep, when you go through open enrollment, you would see that in your enrollment portal if your plan is a high deductible health plan, and then also have that option to add on to that HSA when you're electing that plan. So if you have questions, definitely direct those to the benefits team at ESI, but we are here to help and make sure you guys understand what a high deductible health plan is, and what options you have through your employer.
And team, and just to reiterate, and I think you mentioned that, right, Eric, but you're paying upfront costs, but you're paying the negotiated rate. It's not just a retail rate. That's very important to understand in the beginning.
Exactly. All right.
Okay.
As I said, if you have a high deductible health plan and you meet other criteria, then you're eligible to set up an HSA. What I mean by other criteria, you do have to be an adult. So I know everybody on this call is, but you can't open an HSA in a child's name. So you have to be an adult. You can't be claimed as a dependent on somebody else's taxes. So spouses don't count. A spouse can certainly open an HSA. But if you have let's say you have a child that is, 18, 19, 20, and they're on your plan, if you're claiming them as a dependent, they cannot set up their own HSA. So you have to be an adult, not be claimed as a dependent, and then you cannot have other disqualifying coverage. So if you're covered through your employer under a HSA qualified high deductible health plan, but separately your spouse is covering you through their work on a copay plan, or maybe your spouse has an FSA, a flexible spending account that can be used to pay for your expenses, that would disqualify you, so you wouldn't be eligible. But as long as you don't have that other disqualifying coverage, you can set up a health savings account. A health savings account is basically, it's a special type of tax advantaged account that allows you to use money on a tax-free basis to pay for eligible medical, dental, and vision expenses. And when I say on a tax-free basis, what I mean by that is whatever your tax rate is, that varies based on income. Whatever your tax rate is, you're going to save that amount. So if you, for instance, earn as an individual between 50 and I don't know where the upper cutoff is, but maybe 80, 90, 100,000, somewhere in that range, you're, I think, in the 22% income tax bracket. So that means you essentially get a 22% discount on anything you use that HSA for, because you're not paying tax dollars on it. You actually get the discount when you put the money into the account. So the year that you contribute to your HSA, that full amount is a deduction on your taxes. And there's a couple of ways to do it. You can contribute directly to the HSA administrator, which is going to be a bank that opens, that account for you, or you can, in many cases, contribute through payroll deductions. If you contribute directly to the administrator, so you write a check or transfer money from your bank account to that account, then when you file your taxes, basically it would reduce your taxable income by whatever amount you contribute. If you contribute through payroll, you actually get an instant tax break, because instead of the employer doing the withholding, or in this case, ESI doing the withholding from your paycheck for your full tax amount, that amount would come off of your taxable income. And so your paycheck actually goes up. And in most cases, you're also going to save Social Security and Medicare taxes. That's another 7.65%. So altogether, you're saving close to 30% in taxes of whatever amount you contribute to the account. Over time, that account can grow. So if you contribute on a regular basis, then of course the money is going to increase minus any amount that you take out. So as long as you have more good years than bad years, the balance in your HSA can continue to grow over time, and it can actually earn interest income. And most HSA administrators will also allow you to move a portion of the money into an investment account, so you can earn investment income as well on the amount that is in the HSA. So it's a lot of great benefits. You get an instant tax break. You can grow tax-free when you take the money out. As long as it's for eligible expenses, it's always tax-free. And Amber and Erica, I don't know if you want to chime in there and add anything, or if you have any questions.
Yeah, if anyone has any questions, but again, the ESI does, which we'll go over, have a HSA provider that you can go directly through with us to, again, make sure you take that advantage of that tax-free savings on your payroll.
Perfect. One other really important point here, I think, some people might be hesitant to contribute to this sort of account because they might confuse it with a flexible spending account or an FSA. That's an account some of you may have had at a prior job, right? What an FSA is something where you have to decide at the beginning of the year how much you're going to contribute. And if you don't use all that money by the end of the year, you lose it. An HSA is different. That account belongs to you. The money rolls over from year to year. So if you don't use it all in one year, that's great. You just start the next year with more money, and it is portable. So if you ever leave your current employer, you take that money with you. You own the account. So there's really no risks with an HSA. It's a great way to sort of save for a rainy day.
Perfect.
I think we can move on. So obviously the next question then is, well, how do we, if I take advantage of this, how do I actually use my HSA? So an HSA can be used for all sorts of expenses. So any expense on your health plan. So if you go to a doctor, you go to the pharmacy, if you have a hospital stay, you could certainly use your HSA for any of that. But you can also use your HSA money to pay for dental and vision expenses. And you can pay for those medical, dental, and vision expenses for your family members as well. And that's true even if they're not on your health plan. So most people are not going to have trouble spending the money in their HSA. One question that we do get is, well, what if I'm great about contributing, I'm fairly healthy, and it grows to a large sum? What happens when I retire? Am I in danger of losing that money? And the answer is no. Even if at some point you no longer have an HSA qualified health plan, you still can continue to spend the money. So you have to have the health plan in order to contribute to the account, but you can always withdraw the money for eligible medical expenses. And that includes your Medicare premiums once you turn 65. So Medicare for 2026, the minimum premium is close to $200 per month, and you can actually pay that out of your HSA. So it's a great vehicle for paying for those expenses you're going to have at some point, but not having to pay with after-tax dollars.
Eric, and you said something very important there with the family spend. So you don't have to be on what consists of a family, and then you don't have to be on the plan in order for somebody to utilize your HSA. That's in what the definition of the family is.
Correct. Yeah. So as long as basically you can spend the money for yourself, for your spouse, and for any tax-dependent children that you have. So we actually created I guess what we're calling an HSA calculator tool, which sort of illustrates the savings that you can get with an HSA. And Corey, I don't know if you'd like to do this on your end or you want me to do it, but I can actually kind of show you real quick the impact.
I'll bring it up real quick for you if you want.
Okay, perfect. Do that. All right, so we may need to enlarge that a little bit just to make it a little bit easier for people to see. Okay. But basically, what we did here is we created a tool to kind of show you the true impact of this, because there's a couple of ways to do it. One is you can certainly put the money in your account and just let it roll over from year to year and use it as a savings vehicle, much like you might use an IRA or a 401k, right? But you can also just spend the money out of your account on what it's intended for, which is medical, dental, and vision expenses. And when you do, like I said, you get an instant tax break by putting the money in your account. So let's say that you don't contribute regularly. Let's say that you've opened your HSA, you put $50 in it or whatever, just to have a positive balance. And now you have a big claim. Let's say you have a $2,000 claim. So what this tool does is it allows you to select your tax bracket. So Corey, if you could click the drop down there. So a lot of people are going to be in that 22% tax bracket between $48,000 and $103,000 a year. If you earn less than that, so between about $12,000 and $48,000, you're in the 12% tax bracket. If you're a higher income earner, you're in a higher income tax bracket. But we'll just stick with the 22% as an example. Let's say you make $50,000 a year, and then let's say you incur that $2,000 expense. Okay, so we'll change it to $2,000. So instead of just going to the hospital and handing them a credit card and paying the $2,000 with after-tax dollars, you've got a couple of choices. One is you could just quickly decide, I'm going to contribute that amount of money to my HSA over the next next few weeks. So you can talk to your employer, you can increase your contributions through payroll, or you could write a check directly to the HSA administrator that you're using. If you contribute through payroll, you're going to save not only that 22% federal income tax, but you'll also save the FICA, the Social Security and Medicare taxes of 7.65%. So together, that's a savings of 29.65%. Since you're not contributing regularly to the account, you're really doing it just because you incurred this big expense. A way to think about it is it's as if you're getting a discount on your healthcare costs. So if you contribute through payroll, in essence, you're paying $1,407 rather than $2,000 for that expense. If instead you contributed directly to the HSA administrator, so you save just the 22%, it's as if you pay $1,560 rather than $2,000. So everybody likes a deal. Everybody likes getting a discount. If you think of the HSA almost as a discount on what you pay out of pocket for healthcare, I think it's kind of a good way to think about it, and it shows you why you should do it. Mm-hmm. Now, some of you might say, well, yeah, that's great, but I don't have an extra $2,000 right now that I can just contribute to my HSA. That's not a problem. You could go to the hospital, give them your credit card to pay for that $2,000, and then over the next few months, contribute regularly to your HSA through payroll to build that balance up to $2,000, and then you can reimburse yourself with tax-free dollars. So you don't necessarily have to have the money in your account when you incur that expense. So it's pretty flexible benefit.
Yeah, you're kind of seeing that tax advantage savings on then over time your overall taxable wages are going down to the same place. And 29.65% is, you don't even get that in the stock market or your 401k type of thing sometimes. So that's great.
No, I always think about, the fact we live in Texas where, once a year they have that sales tax holiday, and mm-hmm. people will line up around the block at stores to save 8%. But saving almost 4 times that amount, that's a pretty big deal.
Yeah, it's almost like, let's pause right here, take this in, and then we'll keep going. But that's a big amount right there, just in that showing.
Exactly.
Amber, anything, Erica, anything additional on that one?
Not on this part. I was just going to highlight, the funds, your high deductible or your HSA goes with you. It stays with you. So any funds that you're contributing just gets to stay with you, which is such an advantage of going if you leave for another employer. So just re-highlighting what Eric said, I think that's huge, that it is your money. So it's not going anywhere. You're just getting those tax savings by putting that in there through payroll. So
thanks.
Yeah.
Yep.
And I think it's worth pointing out, if you do use your HSA money for something else, then there is a penalty attached. So let's say that you put over time $3,000 into your HSA, and then you decide you need a new bowling ball, and you use the money from your HSA to pay for it. You are going to have to pay taxes on that money. So basically, whatever the cost is, whatever you take out for an ineligible expense, that is going to increase your taxable income, plus you pay a 20% penalty on it. I guess I should have selected something that I actually know what the cost is of it, but let's say a bowling ball is $100. Basically, that $100 would be treated as taxable income, and you'd pay a $20 penalty when you file your taxes. So it's a good idea. Basically, contribute what you can. It's a great savings vehicle, but don't take the money out of your account for ineligible expenses. Now, when you turn 65, let's say that you've got a really big balance in your HSA. When you turn 65, if you feel that you've got more money in your HSA than you're going to spend on eligible expenses, you can withdraw the money at that time without paying a penalty. So if you turn 65 and you want to take out $2,000 and go take a cruise, you can do that. It will be treated as taxable income, so you pay taxes on the money you take out, but you would not pay that 20% penalty starting at age 65.
So a good idea to keep documentation of any expenses that you reimburse yourself for, just in a folder in a file. Keep it there.
Absolutely. So as the account holder, you are responsible for keeping track of those receipts. If you ever get audited, the IRS is going to want to see them. So shoebox, a file folder, or even, taking a picture of the receipts and keeping them somewhere electronically, that's a good idea. Stay a little bit organized, and that's going to help you not only when you're filing your taxes and it asks you how much money did you take out of your HSA and how much of that was for eligible expenses, but you'll also have those receipts there if you ever are asked to produce them.
Mm-hmm. Just to remind, or for everybody's edification, we will be sending out the survey with the link to these slides. So if you want to get on and utilize Eric's calculator for the HSA and kind of play with that as you're understanding your enrollment or where you're going into, that's going to be available for you also.
Perfect.
And I think the last bullet we had here, so we talked about, your taxable wages go down, which is great. And then you get to invest, or you have monies in your account that are strictly for your medical or anything that comes up, paying on the carrier's price advantage. And then the last thing is kind of that triple hit is like that investing options in HSAs, and maybe touch a little bit on, it's not aggressive investing, but you are able to go into, I believe, even up to index funds, but maybe Eric, you have, or Amber, you have a little light to shed on that.
Yeah, each HSA administrator is going to be a little bit different in the funds that they have available. I know that ESI has partnered with HSA Bank. So most of you, if you set up an HSA, will probably do it through that administrator, but you're certainly free to choose another. But it's kind of like a 401k or an IRA in that you have several different mutual funds to choose from. It is investing, and there is an inherent risk in that. Stock market could go up or it could go down, which means that you can make or lose money. So as Corey said, maybe be careful about being, too aggressive. It might be a good idea to, keep a certain amount just in your account that isn't invested, so it's available if you have, any unexpected medical costs. But as you start to build a balance, shifting some of that money into an investment account, it does give you the opportunity to grow the account faster. So it's certainly not a bad idea. But like with any investment, just look at how close you are to retirement, how much money you have, and your risk tolerance level before making a decision.
Right. Yeah. Especially if you're not hurt now and things are going well, and it's almost like that 401k for medical. Exactly.
Yeah.
Let your money grow for you.
All right. So we've already kind of touched on the fact that to be eligible, you do have to be enrolled in a HSA qualified high deductible health plan. You can't have other first dollar coverage, so you can't be on a spouse's plan that pays upfront prior to the deductible. If your employer allows it, you can make the contributions through payroll, and doing so means you'll get the federal income tax break, but also the Social Security and Medicare tax break, and you'll get that instantly. So what that means is when you're filing your taxes, you don't get to double dip. You don't get to get the instant tax break and then also take the deduction when you file your taxes. But it does mean that you get a quick benefit if you're contributing through your employer. Now, let me just give you an example. Let's say that you decided you were going to contribute $50 per paycheck to your HSA, and you're paid twice a month. So it'd be $100 a month or $1,200 a year. But then you get to the end of the year and you say, I really wish I had contributed more. You actually have until April 15th of the following year to contribute up to the maximum amount. So we're going to show the maximum amounts here in just a moment, but basically you would be able to contribute for the 2025 tax year all the way up until April 15th of 2026. You would just need to designate with the administrator what year it was for. So in our example, let's say that you contributed $1,200 through payroll. You've already gotten a tax break on that. That's fantastic. let's say in March, you decide I'm going to contribute an additional $3,000 and designate that it's for 2025. You can do that. And then that $3,000 would become a above the line deduction that would adjust your taxable income when you're filing your taxes.
So you can do it basically with that HSA too, just like people might do with their IRA or something.
Exactly. That was something I took advantage of this year. I actually do have HSA Bank as my administrator, and it could not have been easier. So basically, you just say, make contribution, select the tax year that it is for, and I have my bank account info in there, so I was able to just sweep money over from the bank account into the HSA.
Right.
ESI's preferred partner is HSA Bank. Amber and Erica, I know you may want to mention, because it does say that ESI can assist in setting up an account, through HSA Bank if you want guidance, but you can also use your own administrator, or if you have an HSA from a prior employer, you can choose to use that instead.
Yep, both of those, exactly, Eric. Both of those. HSA Bank is a bank that we can, if you don't have a preferred HSA provider, just reach out to benefits@esi.com and we can get you set up. We'll walk you through that step. We'll help you get set up, and then you can register your account. So we can definitely help you get that process started. But if you currently have an HSA provider and you have the account information, again, just reach out to benefits and we can help get that set up and those payroll deductions started for you.
One other thing is, you are allowed to have more than one HSA. So just because you have an HSA through a prior employer, that doesn't mean you have to continue to use them. You could choose to open an account through HSA Bank if you wanted, and contribute through there. Obviously, whoever you're contributing to, there is going to be a cap per year on the total, but we do get that question a lot. Can you have more than one HSA? And yes, you can.
We still have to watch the limits obviously on both of them, right? Maybe
Yeah.
a softball question on that. Yeah.
All right. So as far as what those limits are, they change every year, and they depend on whether the amount you can contribute depends on whether you have single coverage or family coverage. And a lot of people struggle with this concept, I think, because with health insurance, there's employee only, employee plus spouse, employee plus child, or employee plus family coverage. With an HSA, basically, if you're covering more than one person on your health plan, that's considered a family plan for contribution amount. So basically, if you're covering just yourself, employee only, you're the only one that's on the health plan, then that's considered individual coverage. For 2025, you could contribute up to $4,300 to your account. If you're covering you and your spouse, you and your child, or maybe your entire family, that's considered family coverage, in which case you can contribute up to $8,550 in 2025. And then if you are age 55 or older, there's also something called a catch-up contribution. It allows you to contribute an additional $1,000 per year. So just a couple of quick notes on that. If let's say you do have family coverage, you're covering you and your spouse on your health plan, that means that the contribution limit between you and your spouse is $8,550. You could open an account, you could put the full $8,550 in there. Or your spouse could open an account and he or she could put the full $8,550 in their account. Or you could both open an HSA and you could split that $8,550 however you want between them. Doesn't really matter, because remember, you can spend your money on yourself, your spouse, and your tax dependent children. So you may want to open one HSA, you may want to open two. If you're over 55 though, and you want to make that catch-up contribution, that does have to be made to an account in the name of the person who's over 55. So if both you and your spouse are 55 and older, you could each open an account, split the $8,550 however you want, but then each make the $1,000 catch-up contribution to your own account. It's something that, you know, Corey, I know you've been involved in this. We're part of an insurance association, and we've lobbied for years to get that rule changed. And so far, we've been unsuccessful. So for right now, if you both want to max out your account and make that catch-up contribution at age 55, you do need to have the 2 accounts open. So again,
we'll keep trying, Eric.
We'll keep trying. Those are the catch-up. Those are the contribution limits for 2025. So you have until April 15th of 2026 to make those contributions, as long as you have the HSA open by December 1st of 2025. For 2026, the amounts go up a little bit. So instead of the $4,300, it goes up to $4,400 for single coverage. Instead of the $8,550, it goes up to $8,750 for family coverage. That catch-up contribution remains at $1,000. One quick note: I did say that for 2025, as long as you have an HSA qualified plan and you open your account by December 1st, you can contribute that full amount. There is a caveat to that, and that is if you did not have the HSA qualified coverage for all of 2025, let's say that it, you know, started part of the way through the year, whatever, you open your account later in the year, if you want to contribute more than what's called the prorated amount, meaning whatever your contribution amount is divided by 12, multiplied by the number of months you had the HSA qualified coverage. If you want to contribute more than that, then you need to stay HSA eligible for the entire next calendar year. So if you're not confident that you're going to keep that HSA qualified plan for all of 2026, then the best thing to do in 2025 is prorate your contribution. And again, that just means, you know, divide the maximum contribution, the maximum single or family contribution, divided by 12, multiply that by the number of months that you were eligible for an HSA, and just limit it to that amount. And then you don't have to worry about staying eligible that next full year. If you instead want to take advantage of that last month rule that allows you to contribute the full amount, and then you don't stay eligible for the next year, then any extra amount you contribute, that becomes taxable income and you pay a 10% penalty. So it's a great option. You just need to be careful with it.
Very good.
All right. And I tell you, I've talked a lot, so I'm going to take a sip of water and let Erica and Amber answer or talk on this slide about where to learn more and what resources are available.
All right. Eric and Amber, I'm going to get out and bring up our landing page. So if you want to add anything to there.
Perfect. So after this slide, like we mentioned, we're going to mail out the slide deck for you, but we also have a landing page that you can also be able to view this webinar again. You can have access to the slides. All the contribution limits are listed there. If you want information how to contact benefits, I know I mentioned that your benefits team is here to answer questions, help you in any way that you have. You can reach us, definitely contact us, and then any questions, you know, maybe we didn't cover, feel free to enter them in the chat now. We can talk about those or bring those up and help answer some of those questions, but there's also some frequently asked questions on the landing page.
Perfect. All right, with that, yes, and and as we get the videos of this presentation, we'll be adding to the landing page, so it's still growing. So keep that in mind. And if you don't have access, as I'm doing these, we also have a QR code you can scan now. And let's see here. There we go. So you can also scan that QR code with your phone, just for if you're on the road or during the presentation, or didn't have a chance to write down the landing page. Is right there for you. All right, and with that, Amber, Erica, and Eric, thank you very much for the information and the content. And let's see if we can open it up to any questions. On the webinar, obviously, see you can raise your hand, have anything, you can place anything in the chat, anything that need to more descriptives for you. We're happy to answer those right now. One thing I was writing down, Eric, when you were going through the presentation, when you said when you turn 55. So unfortunately, this month, Eric and Amber, I get to do an extra $1,000. So it's coming your way.
Congratulations.
Double nickel right there. But you were saying now, if I wanted to take, is it the same way? If I wanted to take my time and say, I don't have to actually contribute to that for 25 until April in 26, would that still hold true for that one then? Okay.
Yes. So basically, any amount you're eligible to contribute that you haven't already contributed, you can do the following calendar year up until the tax filing deadline. Now, if you file for an extension, you don't get an extra 6 months to contribute. So it is the original tax filing deadline. So it's normally April 2nd.
Okay. Very good. Okay, C1, I'm going to read it off here. Do you need to be on a medical insurance plan with ESI to qualify for an HSA? For example, I have a medical insurance from an inherited policy from my deceased spouse.
That is a great question. For payroll purposes and for, for us, you do have to be enrolled in a high deductible health plan within our system. It doesn't have to be the ESI plan, but if you are in a high deductible plan and we are taking your deductions, we can set that up. But one thing we can do is help get you in contact with HSA Bank to help you get an account set up so you can make those deductions straight with HSA Bank.
I also think, it's important to point out that, you mentioned your deceased spouse, so sorry about that. A lot of people do ask what happens to my HSA when I pass away. Basically, if you have your spouse listed as the beneficiary, because it's an account, and just like any bank account or investment account, you do list a beneficiary, what somebody who would receive the money when you pass. And so if your spouse is the beneficiary, then the spouse inherits it as an HSA, so they can spend the money on medical expenses without any sort of tax consequence. If anyone other than your spouse is your beneficiary, then basically the account would be cashed out. You would receive the money, or they would receive the money as cash, and the government would keep its share since that money was never originally taxed.
Great points. Great question. And again, yes, as Eric said, sorry for the loss, but great information. Thank you, guys. Another question. I have a high deductible health plan, but my husband has a copay plan with only himself covered. I can open the HSA, but only put in 4,300 limit, but I can pay for expenses that he incurs. Correct? Question mark.
Yeah, you got it exactly right. So you can spend the money on yourself, your spouse, your tax dependent children, whether they're on your health plan or not. But the fact that you're going to be the only one on the health plan means you would have the $4,300 contribution limit. Right.
Great. Thank you, Stacy. All right. Any other hands or questions? So one last point that I would like to make, I mentioned I've worked for an HSA administrator for 3 years in the past, and the CEO of our company, he had a great saying that I think kind of drives why you should open it, because there are certainly people that sign up for the high deductible health plan, but they never open an account. And he used to say that's like saying, give me all of the bad and none of the good, right? Increase the deductible, take away those upfront co-payments, but don't let me pay with tax-free dollars. Doesn't make a lot of sense. So if you have a qualified plan, at the very least, it makes sense to go ahead and open an account, throw in $50 or $100, right? You don't have to make regular contributions if that's not in your budget, but at the very least, if you have that account open,
at the time that you incur an expense, it at least gives you the option of paying for that big expense with tax-free dollars. If you haven't opened your account and you incur a big claim, you don't have that option. So you want to make sure you get your account open, even if you don't have it fully funded.
Yep, great point. And we were all young and invincible at one time too. And I promise you,
Exactly.
after this birthday, stuff breaks down. No matter
You
how
start to
well
fall
take
apart
it.
at some point. Yeah.
Exactly. So you will need those funds. And the other thing is we called it the triple hit, right? Team, it was about the you're able to do taxable wages, less than your taxable wages. You contribute savings, and it's almost like a medical 401k, and then you can also, it works for you as, so even if you don't have anything now, as Eric pointed out, the little you can, or if you can hit all the, especially if you can maximize it, and especially if your employer, let's say, even has a match, it's kind of like one of those, you're leaving money on the table. And the other thing I would actually say, probably not part of the triple header, but it's negotiated rates, right? So you're paying for those, but also, let's say it's something outside of the medical plan's coverage, you have cash now. In cash, you can actually go in those offices and negotiate. I've done it before, and it's very beneficial for that. So it gives you a little more power back to your health and to do with it as you need to. So, and that's a perfect thing that HSA is able to give. So, Amber, Eric, anything else before we wrap?
I think that's it. Just thank you very much for your
All right.
time, and hope it was beneficial.
Yeah, absolutely. It's I've obviously been training and learning with you for many years. It's always a great, and I never come away without learning something, or like, oh yeah, I remember that, and I had to put that in the frontal lobe type of thing. And again, if you're with ESI, Amber and Eric are here to help, and the team, or if we go through, as we go through open enrollment, we'll have other subject matters on this also. And I put the benefits at ESI PEO in the chat. Please utilize that if you have questions. Again, we will follow up with a survey. There will be a link to the landing page that we create, and that landing page will also be evolving with the videos and other stuff. So please don't hesitate to reach out, whether you're a client or not, employee or not. We're here to help tackle that amazing thing called benefits, but it is very vast out there. So thank you, team. Thanks for the presentation. I sure appreciate it, and we look forward to another one soon.
Have a good day.
Thank you.
Bye-bye.